Welcome to the Beyond the Numbers podcast. Before we dive into this episode, we want to share an important disclaimer regarding the content of our discussions.
Hello and welcome to the latest episode of Beyond the Numbers, which is a Live Smart podcast. On this episode, we want to talk about regrets of the retired. It's a topic that I guess it's one of the ones we've wanted to do since we started the podcast. It's going to be less technical than some of the other ones we do, but it's more emotional. So it gives us an opportunity to talk about our experiences of clients that transition from work into retirement and who have spent a long period of time in retirement, and sort of discuss their feelings, their regrets, their wishes. If nothing else, just to give you a bit of a flavour for some of the things you ought to be thinking about as you head towards retirement.
I think it's important on this one, Phil, to note as well. I'd say as we're talking, this is nearly at some stage crossing a case study on every client that ever retires.
Yeah.
It's very rare. I reckon it's probably 1 or 2 in 10 that I would class as they've got the perfect retirement setup. It's very hard to retire perfectly. And I
Yeah.
think people underestimate that fact because of health circumstances, family scenarios, income at different stages of your life coming in, tax scenarios, you name it. I think it's very hard to consider yourself right. I feel like everything's perfect for someone retiring.
And that's why it's so difficult to do, really, because if you think about if you're going to retire at 65, for example, you've basically got 65 years of mess, really, which is, different life stages, different life events, different jobs, businesses, whatever it is. It's just a bundle of previous experience, money, whatever it is, that's led you to where you are, which is why it's such a bespoke thing. Even if you forget what you want to do in retirement for now, it's just looking at what's got you to the stage that you're at now. It's so, if you have two people walk in separately, completely different experiences and completely different background.
And I think as well, we're still getting very similar. There's like 1 or 2 questions that always crop up when you launch into the conversation. So even if you go to where someone's not actually like there's contemplating retiring, but they're almost unsure of themselves, which is often what triggers people coming to us for advice. They've probably never had advice before. When they get to nearly 60, or I'd say 60 is a common one. Sometimes it's 55-ish, and they're like, look, I know I'm going to retire soon. I don't really know if I can afford to. I don't really know what I've got. I don't even know, they don't know really what they've got, what it's doing. Will it even support them? Will it last? So then I'd say as you start talking to them, the concerns start to kick in around. So if I retired today, when might my running money run out? Money running out is always a fear because
Yeah.
obviously they lose the comfort blanket of their income. And I think it creates a bit of anxiety when they've never had financial advice because they're going from zero to like, let's face it, when you get into retirement, there's a lot going on with every asset they own becomes scrutinized as part of what we can extract income from, what is tax inefficient, all that kind of stuff. And I think it's a side effect, really, isn't it, of leaving it till slightly, well, not slightly too late, maybe 15 to 20 years too late. If not, to be honest, you'd rather start in someone's 20s.
Oh, totally. And this is just to close that point off. It's everybody has the same challenges in retirement, but people arrive from different sort of places. Someone who's run a business versus someone who's worked all their life, they still have the same questions, as you say, that need answering in retirement. Am I going to be okay? When can I retire? Am I going to run out of money? So it does rhyme. The questions do rhyme, but that sort of leads us nicely onto the first point, which is I wish I'd started planning sooner. And a lot of this, in my view, is down to the wrong sort of terminology around retirement. I would much rather we were talking about financial independence, making work optional, because if you position it as financial independence, people of all ages can engage with that. If you're talking to someone in their 20s about retirement, they're going to switch off. If you talk to someone in their 20s about making work optional, retire and sort of having financial independence, it's an awful lot more engaging. But really, all you're doing is achieving the same outcome. You're looking at the finances. You're looking at what the life trajectory is, what you need to live on. you're just changing the wording. And that's what a lot of this stuff, a lot of the literature, a lot of the advice out there, it just alienates a lot of the people it should be speaking to.
I think retirement's a really, really non-inspiring word.
Yeah.
Because it basically sounds like you're being, well, it's the old terminology used to be, oh, put them out to grass and things like that. And it's basically like, well, retirement's a negative, it's quite a negative word. I think I've had the conversation a lot more recently around, look, why don't we just try and work out if you've got the choice and then you can choose. And then I think a lot more people who are not entirely comfortable with just stopping work dead, they'd quite like just to have the choice so they're in control. It puts them in control, not money in control.
Yeah.
And I think as well it gives them the option of, phased where they part stop working because they still want to be around people and they still want to have a degree of purpose, even if it just gives them time to develop hobbies that they want to do and time to pass in other ways. Because let's face it, what hours like we work, it's very hard to then think, right, working, not working.
Yeah.
Like I've never had time for hobbies, really.
I don't know what you'd do with yourself.
I'd be a nightmare.
But it's one of those things. If you started speaking, if you went down the pub and started speaking to people about pensions and retirement, you'd be sat on your own, wouldn't you? It's got connotations of things that have happened in the past that haven't given that word good press. But the other thing, actually, just bringing it back to what we're talking about, it's amazing how when you give people if you can turn around and say to someone, work is optional. First of all, it gives it, as you say, it puts them in control. But then often you see people who would change, not necessarily stop work, but change the work to, do something that's more aligned with a hobby or a passion or a purpose. So people who go into sort of charity work or something like that, as opposed to getting off the hamster wheel of just trying to grind to get money because they don't need to anymore.
Yeah, and I think, again, the word pension makes people think that you've got to have a pension. You could have £500,000 in ISAs and no pension. It's not so much about pension as a word, yet it's like used constantly because it's like a major factor that people associate with it. But the reality is, someone could have a portfolio of 20 properties.
Exactly.
Properties, ISAs, pension, and they could all be at different balances, irrelevant at this stage as to what they're going to draw from what. And I think the key is with that, and this is really where we're coming to some of the points that we're going to cover, is if you've got mixed assets as opposed to, well, let's face it, if you've got one asset, you could be able to maximize tax. So you've got the ISA argument versus you move ISAs to pensions, which I've just done some recently, just for the tax relief because they're coming up to retirement. So you think there's less point in them having ISAs because they've not got massive pensions that are then going to carry them into the drawings, over 50k a year. So they may as well have the 20 to 40% uplift, 40% in this case. So you've got that. And then you've got people that are carrying properties into retirement. And let's face it, even if you've got 2 or 3, which is common, it's great when you're young. And even, what am I? I'm 49 and I'm just in the process of renovating and selling my last property. I have had enough. I've probably bought and sold 20, 30 properties over the years. At times I've held 10, maybe it's never really gone above 10 because I've always then done some up and just sold them so I didn't want more tenant hassle. How many people are coming up to retirement and then they're holding property, say 2 to 3, even 1? I'm 49 and very active and physically fit to do my own renovation, and I don't want that anymore. I don't want it. I'm too comfortable to have the hassle of it. And I think there's people that then wait 10 years beyond me and they don't even, they don't do manual work. They don't want confrontation with tenants that have not paid rent. And
it's funny, isn't it? If the people who don't have property investments wish they did, and the people who do have property investments wish they didn't.
I wish I didn't 20 years ago. I don't, in truth, it's one of them scenarios where I look back with a degree of regret, not because of what I could have made elsewhere and all that rubbish, but the hassle I've had for probably 15 years. I just think what is the point? Like when you can make, even if I made similar money elsewhere, or even if I just went on holiday more. I think if you get a certain level of security, income or comfort, property's a bit of a no-no at times.
You're basically running a business in retirement anyway. But should we let's move on to the next point,
Yeah,
shall we?
move on to some of the key points.
So underestimating how much you need in retirement. So this is quite a big topic, and it fits into what we were just saying about sort of understanding what your numbers are. So the first thing to
As to this, Phil,
sorry.
I think there's a bit. This is a bit two-sided. I think some people definitely underestimate. I think some people overestimate what they need because their need is not that big.
Yeah,
You get that a lot, and to
you
the point
do.
where people think you need £1 million in a pension or something because they've heard it on, they've read it in the media. Well, yeah, you possibly do if you want 50 grand a year. You need 50 grand a year to pay your bills in retirement, but most people don't.
No, but it's much easier to solve one than the other. It's much easier to deal with a situation where you've got too much money than not enough money. And that's why
Without,
and it goes back to planning earlier, doesn't it?
yeah, and planning to save the amount you need rather than save too much or too little.
And some people hold too much cash in retirement and they think, well, I've taken, and some pension funds are not sort of helpful when you're creating this case with when they lifestyle you right down to take basically no risk when you retire. If you're retiring for 25, 30 years and all you've got is cash in the bank, inflation over the past few years, you're really going to struggle to, unless you've got your numbers bang on, you're really going to, and you're basically holding too much, you're really going to struggle to maintain that cost of living, which is just increasing year on year on year, if you've not got things that are also increasing with them.
I think this touches on the point of cash in, people carry cash ISAs and just cash into
Yeah.
retirement. Often, to be honest, I'd say too much more than I'd like them to generally. And I don't think people in this country there is a massive lack of understanding around cash, inflation, in terms of effect, not just what it is. I know people know what it is, but I don't think they understand the effect when they learn, and I don't think they can put it in context against the return they get on cash. Just like they can't contextualize what the interest rate is in a mortgage or a loan versus what they would get return. The amount of people that will take a loan to keep money in the cash ISAs, and the loan's
Yeah.
4%, the cash ISAs are 3%, and you're like, that makes no logical sense then.
Well, until fairly recently, if you look at it over a long period of time, having cash in the build up to retirement kind of made sense because you'd have a cash event when you retired and you'd buy an annuity, but people aren't really buying annuities anymore. So it's massively changed the landscape in the sense that you need your whatever you've accrued to remain invested because that's got to provide you with a rising income over a 25, 30 plus year period.
When was the last time we did an annuity?
Oh, while ago.
I think I did one 10 years ago.
They just the whole landscape sort of changed. I mean, they do have their place sometimes, but the state pension provides you with provides a lot of people who have been working and have accrued the entitlement provides a decent sort of basic rising income. So people don't really and the yields aren't as good as they used to be. So people aren't sort of buying them anymore. And as a result of that, if you're then not investing, keeping yourself invested, you're going to struggle potentially.
I think around some of these subjects as well, I think some of the biggest culprits of leaving it to the last minute, bearing in mind in some ways this is a market I operate in quite a lot, for people with company pension schemes. People with a company pension scheme has a bit like if someone's got a big cash balance, it lulls people into a false sense of security. Because it gives them, if it's defined benefit, it gives them obviously defined amount. So say they know that they're going into retirement at 60 with 10, 12 grand a year, and they know they've got 50 grand in cash, and they know they're going to get a lump sum of 25 to 50k. It lulls them into a false sense of security. And what they've not based it on is what they need. They've just based it on what they've got coming.
Yeah.
So they almost ignore what they need, and then therefore they don't need to speak to people like us because they're like, I've got my pension sorted.
It's the wrong way. It's the wrong way of looking at things, isn't it? Because you're basing your lifestyle on what you've got coming in, rather than basing what you've got coming in based on your lifestyle.
Yeah, and obviously by doing that, what you find is a lot of them have not been very ambitious in terms of setting a goal to think, actually, I want to retire on these terms. with this amount of money coming in, says, I want to spend 15 grand a year on holidays. What they actually do is think, well, yeah, I've got 10 to 15 grand a year coming in. I can live on that. So it's quite I don't know if it's because they get things that part of the population get a lot of things done for them. The pensions managed for them, the amounts going in have been managed for them. They don't. It's like they're conditioned to not think they've got choice. A bit like when you get a job, your boss tells you what to do, kind of scenario, rather than you think, right, I don't want to do it that way. It's better this way. I think it's a conditioning thing to having things done for you. You see it a lot with NHS staff because they've got pensions and things taken care of. They've got death in service teachers. And when you start to stimulate the conversation a little bit and you switch it around, and I've had this a lot with teachers, yeah, and NHS staff, and then you see what you can actually do with their stable income, stable pension. Everything gives them an underpin, doesn't it, to take a lot more risk so they can then get more return on what they do invest because they've taken more risks. They've got the guaranteed underpins. They don't need to spend as much on insurance, technically, so they've got often fairly large death in service scenarios. All this stuff adds up where it gives them the ideal opportunity to have a really comfortable retirement with an underpin of guaranteed income. Often they don't seek planning because they don't think they need it because they're not coming at it from a need perspective.
Hmm.
And I think that's a key issue on employed staff.
We should move on, but quickly, while we're talking about this, business owners, one that we've mentioned it in a previous podcast, one of the things that sometimes we see with small business owners, particularly sole traders, is that they assume that that their business is going to be their pension and their retirement, which is, as we've touched on previously, a massively risky strategy because often if you've got a sole trader, a small business, if you take the owner who's grafting 12 hours a day, if you take them out of that situation, the business isn't worth anything.
Honestly, over the last 20 years, if I had like £100,000 for every client I've had who's got a business and tells me what the business is worth and they don't get it. And when I say they don't get it, if they say £500,000, I'm thinking in my head 100 grand max. And I'm nearly always sort of quite right. Because the problem is people think a business has got value when they work in it.
Exactly.
And a business that they work in is very hard to sell because whoever buys it has got, and I'd be the same, we'd be the same. You'd have anxiety, wouldn't you, about what happens when all those relationships break that are connected to you? Will people go elsewhere? Even down to how the business gets paid is based on the relationships where the owner of the business can ring suppliers up or whatever and say, oh, we've got a bit of debt building up here. Can you settle it? And yeah, oh yeah, mate. Yeah, sorry. Yeah, we'll send you some money. It literally is run like that. I think, it's not really a business with value.
But on the flip side of that, if business owners engage early enough, quite often they've got reasonably good incomes, sometimes very high incomes. So there's lots of planning opportunities whilst you're 10, 15 years away from that desired exit. And also, just to, again, before we move on, if you've got a business that has got some value, how are you preparing that business for a sale before you retire? Is it neat and tidy, which means you could potentially get more for it, or is it just I'll sell it when I retire? Because those are two very different things with very different outcomes.
Well, as well, it's amazing how many people have got a business with people in the business, and because they've never sort of empowered them in any way to take control of key function in the business, they work for them. And as you know, it's not easy to do. I'm sort of trying to do it here and there myself. And it's, the staff aren't conditioned to take over that business, which is, let's face it, if you can't sell a business for your £500,000 that you think it's worth, are you better just giving it to your staff and then thinking, well, I'll just carry on drawing 50 grand a year for another 5 years into retirement, compared to trying to get £500,000 and then ending up with nothing, which is common. Most businesses just get shut down. So a lot of it, just the goodwill goes everything, because obviously once people have decided they're retiring and they can afford to retire, they're not going to strive, are they, to do any more in the business? It's pointless because otherwise they're not retiring. So even if people just start thinking of the staff different and nurture the staff to not be frightened of taking over the business, because what have the staff got to lose? And then you think, well, even in my case, if I got to 60 and I said to you, what, you just take over everything and then just pay me out 50, 100 grand a year for 5 years or an agreed term, it's better that way than getting nothing into it. I think it's better for all the younger people in the business that have no chance of having a business of that scale. They've got to start from scratch. And I see loads of businesses just get shut. I've had one recently, just got shut. The guy used to draw probably 50 to 100 grand a year income and he always had a nice company car. Just the business just shut.
Hmm.
So like,
and that's it, because you take that person out of the business. What is the business? Right. Should we move on?
yeah, I would, yeah.
Right. So next point is I didn't speak to my family enough. So this is, you know, quite often when it comes to finance in particular, there's usually a driving force behind it, isn't there? There's usually one partner that's more dominant than the other when it comes to the finances and when it comes to planning. But of course, the big thing is you're retiring as a couple or as a family. You're not retiring on your own. So it's really important that you have these discussions early so that you're both on the same page, or if you need to have a chat about, you know, potential compromises, or if you're going to retire at different times or whatever, the earlier you have those conversations, the easier it is to plan the outcomes for that. Like when we're doing cash flow modeling for clients, how much easier is it to do it when you've got a couple versus one person?
I think the issue is a bit of a trend where amongst, I would say there's always a percentage amongst every generation that runs finances individually. So they have their own bank account and then they pay money into a joint account and then their own money, what's left, is theirs. So obviously what they're sort of doing is they're not thinking about, oh, when we stop work, we've got to do that together. They'll probably just think, well, we'll carry on paying the money into the joint account. But the trouble is then you've got to almost, I wonder at times, are we better doing two individual cash flow modelings, each individual, because they operate as two individuals paying into a joint account to cover the house and the bills, rather than at times trying to get them in as a couple. And then you normally get one that, no, I'm keeping my finances separate. And it's often as a product of broken relationships or divorce. They don't trust pooling finances or don't want the hassle. Or they just got used to their independence from when they were on their own. But I think we need to consider our strategy on that a bit. Because I wonder at times if you're best doing just two individual cash flows rather than nothing.
But if you're married, there are certain things that you need to look at combined, I would say. It's a shame. I would much rather try and engage both parties. For example, at the very least, if you basically discover, and again, the advantage of planning earlier, if you basically discover that one party to the couple has got significantly more assets than the other, okay, they're marital assets for legal purposes. But when it comes to tax planning and everything, if one person's got loads and the other person's got little, it makes it really tax inefficient when you come to draw an income or gains from it. So at the very least, it's tax inefficient, and that's before getting into all the other arguments.
How do you tackle an asset imbalance when one's 57 and one's 50? So like one gets to 57, the other one's 50, and they run the finances separate.
Yeah, but that's where you need to. It's our job to talk
See
about.
what I mean?
I see what you mean, but it's
really tricky. Yeah, when you get these age gaps and things, because obviously in that scenario, one's retiring if they want to retire at 57, and then the other one's 50, so they can't retire.
Well, not necessarily, because there could be non-pension assets and this is the thing. I think it's much more optimal to talk about the disadvantages of not working through it together, and obviously if there's these kind of emotions going on, then that potentially needs some other work separately to that. You're trying to sort of coach people to a better solution for them, rather than, I would say, agreeing to do things separately, where I don't think that's the most optimal thing to do. That's a debate.
When you've got these age gaps and when you've got these imbalances, and then obviously particularly when you've got company schemes mixed with non-company schemes, so then you tend to lean towards company schemes 60, which if it collides with someone being younger, they're 10 years off when the other person is able to retire at 57 because they're older. obviously when you get state pension, it comes in sooner for that person. And I think they're the ones that are some of the trickiest situations. Because what they tend to do then is because you can't, there's no real solution, is there, unless they're really wealthy. Um, well, there's no solution, so they're like, well, where we just keep everything separate. So I think it's something we need to consider because it cropped up yesterday, and I thought, you know what, I've not really. There's no set solution,
No, no,
and it's
no. That's why. But it is bespoke, isn't it? You need to understand both parties to it.
they need it. They need the planning more than anybody, but there's
Yeah.
actually no solid solution. It's a real grey subject.
Mm.
And you think actually it was quite an interesting case because it's not very often I get surprised by something. I think I've seen it before, but I've not seen it that that much that detrimental. Where you think we're stopping them actually planning a little bit
Mm.
because it's all of the subjects I've just brought up all in one. They've not been
Yeah.
together that long. House might be in one person's name, different parent, company scheme, non-company scheme, age gap. It's just mad.
What do you want to talk about next?
I think one of the key ones is well, there's two. I think there's early and late. So I think there's a real thing where people not starting the process early enough. I've had some people ring me up and say I want to retire tomorrow almost, and you're like, well, I mean, how long does it take us to do anything? Like just to have a meeting and then do a bit of work and then come back and feed back to someone. That's probably 2 weeks for a month, isn't it?
It can take months to get information out of providers.
Yeah, I mean, just doing it. Anything. I don't think people realise how much there is to articulate behind the scenes to put it into some kind of sensible. You got tax calculations and all sorts. You can't just. And obviously to do those, you need precise info. So I think it's the start early. You see massive advantages on outcomes. And when I say early, I mean even if you just on the 2 years running up to it, you just start to get things tidy and get your ducks lined up a little bit. It tends to for me, I see a process where when someone comes to me a bit earlier, we start or I push them and we start, particularly the ones where you're 5 to 10 years earlier on the planning part or getting things organized and tidy, they tend to retire earlier.
Mm.
And it's often possibly me talking them into, look, you can retire earlier. Why would you not?
Yeah.
And it's surprising now that at 52, they're like, no, don't want to retire yet. At 58, you know what, I've had enough. Or they get made redundant. There's a lot of redundancies going off at the minute, and I'm seeing scenarios which I'm having the conversation. Well, look, you've been made redundant. You can afford it. Why don't you just retire?
Yeah.
Well, I've not thought of that because people don't. They get conditioning thinking I'm going to 60. I'm going to 65.
Well, that's it. I mean, how many times, and I've spoken to family members about it, who they say, "Well, I'm going to retire at 67." You think, why? That's because that's when the state pension kicks in for them, or 66 at the moment. You think, well, what have we looked at everything else? Do you need to retire at 67? Because you're only saying that because that's when you get your state pension, but actually you can afford to retire years earlier. And people get sort of anchored to certain years, don't they? Whether it's the year they can access the pension or the state pension age. You think actually that doesn't take into account anything else that you've got going on, or even when you want to retire.
I think the problem is, as a society, we are conditioned to set things, ages.
Yeah,
Think about life. It's organised in bandings on tax, age limits on pensions. ISAs when you can take one out, age restriction on when you've got to start drawing your pension. There's so many bureaucratic restrictions. I think people are conditioned to then they don't realise how much we can flexibly make them retire.
and that's one of the nicest conversations to have with someone, isn't it? To be able to say, look, we've run the numbers based on everything that we've agreed. You're good to go. You don't need to stay at work if you don't want to, or you can go and do that part-time work, or you can go and do that volunteering, whatever you want to do.
Yeah, and I think I've possibly had the conversation more in the last week or two to say to people, look, why aren't you drawing off your investments and assets? Why do you keep drawing from your business? Why don't you let your sons have that or your daughters? Why, because otherwise, you obviously 2027 we've got potential inheritance tax on pensions. Already, I'm starting to think, well, people that have got enough now, they may as well start drawing it because they've got enough anyway. Is my
Yeah,
point.
and it's all of these sort of tax sort of cliff edges. They're all stealth taxes because assets are increasing in value. People are people's wages and earnings are going up. The tax bands are staying exactly where they are, so they're not a headline sort of tax rise. But actually, you've got more people who are going to fall into the scope of inheritance tax. Add in the pension situation to that. A lot more people are going to be needing to review their IHT position, and the best way to resolve your IHT position is to spend it.
And I think it's going to present interesting situations because I know one of the hardest things I have to do when I do reviews is clients get beyond probably 60 to 65, it's harder to get them to spend money. So, and it's not just harder to get them to spend money, it's harder to get them to draw more money because they can, and just focus on dropping their asset down a bit properly up to a given age because they know the logic they're going to spend less, but even though they know the logic, there's a fear of watching the money drop. And then that tends to mean it forces them, and it more so with this pension scenario in 2027, it will force them into big tax bills.
Yeah.
Put it into context, I've got one client that went from, well, their inheritance tax bill is increased by circa 800k. So my advice now is switch to, look, why are you still drawing income out of your business? Why aren't you drawing your pensions? I've almost used cash flow modeling to try and persuade them that they can afford to draw £100,000 a year and still not run out of money, so they're still got to draw more. I mean, who in retirement generally draws much around that?
Well, we go back right back to the first podcast we recorded, and we discussed that mentality shift of going from being a saver and when you're paying off your mortgage and you're trying to build assets when you're working, so then all of a sudden having to completely switch your mindset to then spend your money in retirement. It's harder than you would think.
And I think it's because people by nature put things off and they leave large decisions too late. And by the time that they've got to make these decisions, any advice around them is fairly technical. Think inheritance tax. It's not easy. It's not easy advice. It's not easy to digest. It's quite unpalatable. So you have to be really balanced in your standpoint and your views on it. I don't think people, when they get to where they've left the decisions till really late in life, want to deal with it. I don't think they've got the drive, the ambition to deal with it. I think at that stage they know they're comfortable and they're being comfortable, and that doesn't make you want to deal with stuff, does it? By nature, it's like when you go on holiday, you don't want to deal with things. You're just on holiday because you're relaxed.
Yeah.
I think when people truly retire, it's like a bit of a long holiday mentality, and I think if you're going to start getting things set up, start setting up. You don't have to go all in. But
No.
5% a year, 10% a year, just setting things up for inheritance tax. How you want your life to lay out. I think it makes a massive difference to how well organised it is, how efficient it is on tax, and it sets you on a road rather than where you're coveting the balances. So you get to 75, you're like, oh, I don't want the hassle of that. Tax bill guaranteed.
Hmm.
I get a lot of it, and as you know, I'm quite prepared to push people a little bit, and suddenly be a bit where they could easily get a bit angsty with me because I'm pushing them out of the comfort zone a bit. Because that's what our job is, really. But we still see a lot of people 75, 80, and they've got £500,000, £1,000,000 left, and then they don't give it away. They won't gift it then, generally. They're at cover age. They don't want to think about it.
No.
And I think it's a big downside because the government make fortunes out of it.
Yeah. And that just sort of leads on to the final thing that I want to talk about, which is the idea of sort of dying tidily. And that is basically some people, and it can't really be the regret of a retiree because it's not, but it's more those that have done it are glad they've done it because really eases the burden on the next generation who are going to be looking after their affairs when they're gone. Making sure that you've got everything as simple as possible, having, power of attorney in place, making sure your will's up to date, doing all of those planning things earlier on, which means that there's not a massive inheritance tax bill to pay, but whatever else. But just having your affairs set up in a way that it's easier to sort of administer and manage when you inevitably die, at a point where your loved ones are going through a real sort of difficult period, an emotionally difficult period, the last thing that they want on top of that is a massive burden of trying to find out what you've got where, how much, what the historical gains. Do you know what I mean? All of that other stuff.
I mean, I don't think we use our facilities right yet, but I think I can see we're warming up to doing it. But when you look at things like a client portal, and you can have all your documents scanned in, it's free.
Yeah.
You can see most of your assets. What assets you don't see with an actual valuation connected to providers. You've got you can put like a spreadsheet on. You can make it visible to us or not. You can copies of wills, power of attorney, all that stuff. If we could get every client probably by the age of 55, 60, where all that is a complete folder.
Yeah.
And then let's face it, if the house got burnt down, it's on the cloud, so it stops that. They can give someone else a login. It's their choice, isn't it? Obviously, it might be two-factor, but they can still get someone else can log in. If their family rung us and we got that tidy on death, massive. I mean, I've done it, and I've dealt with people's stuff and helped them out. The difference is massive.
Yeah.
Where sometimes you get the call and you're like, well, I tried to get them to get me a copy of the will. They didn't do it. I have no idea what the will says. Have you got a copy? Well, we don't. We're just having to hunt through the house to find it.
Yeah.
You get the same on. Everyone's got like a folder.
Yeah.
So they're like, oh, is this? Have they still got this? I don't even know they've got that because it's just a bit of paper, like in the house.
Yeah.
Guess it's not, because otherwise, I think we were aware of everything.
You have to ring around all the providers because you don't know whether it's active or not. And
I mean, let's face it, what does it cost? Thousands, isn't it, in time?
But yeah, and legal costs potentially if you've got professional help.
They're then the people that then, because it's so messy, they end up paying solicitors to do probate.
Yeah,
that could be £5,000.
Sweet.
It could only take 10 minutes, 15 minutes online, with us, helping them out.
Yeah.
This is the trouble. I think it creates so many issues, costs, disorganisations, anxieties, stress. When let's face it, they're not in the mood. Someone, family members just died. You don't really want extra, do you?
No.
Same applies when they go into care. You get the same situations.
Yeah.
And again, the people I've had go into care, and then we've got everything organised. I would say I'm almost just the go-to for all information when withdrawal money is needed. It just makes it stress-free.
Yeah.
So yeah, I think it's probably an undervalued point.
Yeah. Is there anything else you want to say before we wrap up?
No, I think that's covered. I think that's covered everything.
So hopefully that's given you a little bit of a flavour as the sort of conversations we're having with clients, and it obviously varies person to person, but these are just some of the themes that we see sort of cropping up time and time again. So hope that's useful. Obviously, any comments would be greatly appreciated.
If anyone wants to do a comment where they give us a case study, we'll go through this again as a part 2 as a case study.
Yeah.
So in other words, then it's just free advice, isn't it?
Well, we're going to touch on all of this good stuff again, aren't we?
Yeah, I mean it crops up weekly, doesn't it?
Yeah. Right, that's it for now. We'll see you next time.